Ladies and gentlemen, welcome back to Vietnam Stock Market's Opportunities. It's an honor to be with you today. And if you want to open a legal trading account, please contact us with the email Vietnamstockmarket.entry@gmail.com, Telegram Vietnamstockmarket.entry, with the phone number is +8491 432 6556. Or you can also scan the two QR codes on the screen so that we can support you. And the other way to contact with us is please follow and subscribe the channel name, Areca Capital Channel. The owner of this YouTube channel is Areca Nguyen. She's a personal financial advisor and a Viet Capital Securities Stock Program Manager. You can contact her with the email hongzhengyuan@vcsi.com.vn with the phone number is +8491 432 6556. We always welcome you to our office on the 11th floor, 109 Trường Đạo Street, Hoàn Kiếm District, Hà Nội, Vietnam. And today I'm gonna share with you about Vietnam Strategy 2023. Well, the first part is challenging H1, H2 to anticipate global recovery. This research paper is written by a research team consisting of Alastair McDonald, CFA, is the head of research, Associate Director Đức Vũ, Senior Manager Dương Linh, Duy Nguyễn, Hồng Lưu, Nam Hoàng, and Lưu Hoàng, and the manager is Duy Nguyễn. I will cover all the contents of the research as follows. Challenging S1, S2 to anticipate global recovery. Macroeconomic risks in context. Vietnam macro rising external and domestic headwinds. Market data. Banks. Uncertainties remain, but valuations are attractive. Other financials. Higher interest rates to benefit issuers. Consumer attractively value compared to long-term prospects. Transportation. Logistics players expanding capacity to support growth. Aviation continues to recover. Real estate, shorter recovery pathway than last cycle. Industrial parks, structural growth to continue, but headwinds to impact long-term outlook. Construction and materials, challenging year ahead. Industrial manufacturers own businesses that promise near-term recovery. Oil and gas, LNG-fired power plant capacity to expand, spurring growth. Power and water, growth in renewable energy. And the last one is VCI rating system. Challenging S1, S2 to anticipate global recovery. We expect S1 2023 will remain challenging for Vietnam's equity market as a global recession dampens exports demand and the final phase of tightening by the U.S. Federal Reserve constrains the State Bank of Vietnam from easing monetary policy. However, we expect a brighter outlook in H2 2023 as the market starts to anticipate a recovery in global growth in 2024. We set a Vietnam index target of 1,300 for end 2023, reduced from 1,400 previously, 29% above the 2022 close of 1,007. Macro, fiscal policy to step up and offset weaker external demand. Softened external demand started to impact the labor market in Q4 2022, and we expect a further deterioration in H1 2023 as Western economies endure the shock of inflation busting cyclical recession. Meanwhile, we expect monetary policy to remain relatively tight as the SBV continues to manage the Vietnam zone and US dollar exchange rate to control inflation while the Fed completes its tightening cycle. On a brighter note, Vietnam has considerable fiscal room to boost domestic demand with public sector debt well below the cap of 60% of GDP and much of the 15 billion US dollar package that was passed in January 2022 to support us social economic recovery in 2022 to 2023 still utilities. A further recovery in inbound foreign tourism, which was only 20% of the 2019 pre-COVID level in 2022, should provide additional support to the current accounts and domestic demand. In addition, China's reopening from COVID lockdowns represents potential upside risk to our forecast for external trade and tourist arrivals. Meanwhile, growing foreign direction in investment, disbursements, and new restrictions continuing above disbursements are encouraging. We believe FDI will remain a key catalyst for further industrialization and premium GDP growth over the next 5 to 10 years. We forecast GDP growth of 6.5% in 2023, in line with the government's target, and 7% in 2024. Market outlook: EPS forecast still at risk but cheap enough to buy. We lowered our year-end 2023 VN index target from 1,400 to 1,300 and set a provisional and 2024 target of 1,500. Based on our index EPS growth forecast of 11%, 10%, and 14% for 2022, 2023, and 2024 forwards. The VN Index 2022 closing level of 1,007 represents 2022, 2023, and 2024 forwards. PS of 10.5 times, 9.5 times, 8.4 times compares to 8-year average trailing 12 months forwards PEs of 15.5 times, 13.8 times respectively. The key downside risks to our positive outlook are: 1. A deeper than expected global recession resulting in a greater disruption to production, trade, and FDI. 2. Higher than expected inflation causing interest rates to be higher for longer. 3. Financial problems of property developers spreading to banks and the broader economy. 4. Tighter than expected fiscal policy. And 5. Tail risks such as an escalation of the Russia-Ukraine conflict or further anti-corruption developments that disrupt the economy. Banks remain a key swing factor in overall market earnings. While we have already increased 2023 to 2024 forwards, NPLs and credit costs follow the 200 basis point increase in interest rates in September to October 2022, a significant deterioration of the economy, and our forecast could result in further downside risk to our earnings forecast for the sector and the markets. Sectors and stocks for 2023. We recommend overweighting the financials and consumer sectors in 2023 after outperformance compared to the VN index in H1 2022. Our bull basket selection from our catalyst top picks marginally up underperformed on an equal weighted basis in H2 2022, while our bear baskets show modest outperformance compared to the VN index. Our catalyst top picks for 2023 are illustrated. The left-hand column are discussed in more detail inside this report. Challenging H1, H2 to anticipate global recovery. We expect H1, H1 2023 will remain challenging for Vietnam's equity markets as a global recession dampens export demand and the final phase of tightening by the U.S. Federal Reserve constraints the State Bank of Vietnam from easing monetary policy, increases in inflation in Vietnam, and other Asia, Asia Pacific economies have lashed the uptrend in Western economies, and we expect the SBV will not loosen policy until one, there is clear evidence that inflation in Vietnam has peaked, and two, Vietnam interest rates could be lowered without excessively reducing trust compared to US dollar rates that triggering downward pressure on the Vietnam dong compared to the US dollar. However, markets always attempt to discount the future, and we believe that we may already have seen the lows for the VN index for the current bear market in Q4 2022 in the period of peak uncertainty that followed the arrest of the chairwoman of unlisted real estate conglomerate Van Thịnh and unusually high deposit withdrawals from Saigon Commercial Bank, while the global economy and hence export demand are likely to weaken further before bottoming in in H1 2023, we subscribe to the consensus view that there will be a relatively mid-cyclical global recession induced by central bank tightening to combat inflation. We therefore expect a brighter outlook for the VN index in H2 2023 as the market starts to anticipate a recovery in global growth in 2024 and potential policy easing from the USB. We set a Vietnam index target of 1,300 for end 2023 reduced from 1,400 previously 29% above the 2022 close of 1,007. Tier 1 Consensus GDP growth annual. Tier 2 Consensus GDP growth quarterly. Macro fiscal policy to step up and offset weaker external demand. Softening external demand started to impact the labor market in Q4 2022, and we expect a further deterioration in H1 2023 as Western economies endure the drop of an inflation-busting cyclical recession. Meanwhile, we expect monetary policy to remain relatively tight as the SBV continues to manage the Vietnam zone US dollar exchange rate to control inflation, while the Fed completes its tightening cycle. With Vietnamese economy only full reopening from material COVID restrictions in 2022, we believe that rising inflation in Vietnam over the past 12 months has been primarily cost push, driven by increases in input prices rather than demand pull. Although official labor market data showed unemployment and underemployment rates returned to pre-pandemic levels in Q2 2022, consumer confidence surveys and somewhat pedestrian volume growth for mass market consumer businesses in 2022 suggests that inflation was not driven by excess domestic demand. The rebound in commodity prices as the global economy recovered from pandemic restrictions was further inflamed by the escalation of the Russia-Ukraine conflict in Q1 2022, which has a particularly strong impact on prices, energy, oil and gas, and wheat. While Vietnam's food consumption is skewed toward rice, which was not seen dramatic price inflation. Vietnam is a net importer for raw energy and downstream derivatives. As a result, a depreciation of the Vietnam dong and the US dollar will tend to increase the domestic inflationary impact of higher global prices of these commodities, which are typically priced in US dollar. The VBS policy to try to limit depreciation of the Vietnam dong compared to the US dollar in 2022 was therefore appropriate from an inflation targeting perspective. However, as Vietnam only started to emerge from pandemic restrictions in Q4 2021, we believe the SBV initially chose intervention in the foreign exchange market rather than rising interest rates to defend the Vietnam dong for fear of choking off the nascent domestic recovery. This policy was successful in limiting depreciation of the Vietnam dong compared to the US dollar through H1 2022, but the cost in terms of depleting foreign exchange reserves became untenable as the Fed rate raised more aggressively and the US dollar appreciated strongly against most other currencies. In our view, the SBV was therefore forced to raise rates initially via open market operations to restore a positive differential between Vietnam dong and US dollar interbank rates, and then via a 100 basis point hike in policy rates in September. Extreme uncertainty over the potential impact of the VTB SCB situation in early October arguably uh, undermined confidence in the US in the Vietnam dong to the extent that the second policy rate hike late in October came rather sooner than might otherwise have happened. In the same way that the SBV was dealt a difficult hand by more aggressive Fed tightening and US dollar strength than might have been expected at the start of 2022. The recent pullback in the US dollar from its 2022 peak and moderation in Fed rate hikes from 75 basis point to 50 basis point at the December FOMC meeting have given the Vietnam zone a reprieve. In our view, if the consensus outlook for the Fed's frightening circle to peak in H1 2023, with the Fed funds target rate of around 5% proved correct, the SBV should only have to raise policy rates by a further 50 basis point in the current tightening cycle to maintain broad stability in the Vietnam zone compared to the US dollar. However, we do not expect the SBV to start to loosen policy until H2 2023, when we expect there will be greater confidence that inflation has peaked and the Vietnam zone is no longer vulnerable to further strength in the US dollar. While we assume a 50 basis point policy rate hike from the SBV in H1 2023, followed by 50 basis point cuts in H2 2023 and 2024. A less aggressive final phase of tightening by the Fed compared to current consensus could result in no further policy rate hikes from the State Bank Vietnam in 2023. Figure 13. Commodity prices, US and Vietnam's inflation. Figure 14. Commodity price indices. On a brighter note, Vietnam has considerable fiscal room to boost domestic demand with public sector debt estimated at 43.5% of GDP, well below the government's cap of 6%, and much of the 15 billion US dollar package that was passed in January 2022 to support a social economic recovery in 2022-2023 still unutilized. A further recovery in inbound foreign tourism, which achieved only 20% of the 2019 pre-COVID level in 2022, should provide additional support to the current accounts and domestic demand. Foreign tourism receipts contribution an estimated 12 billion US dollar or 3.6% of GDP in 2019 according to the World Bank. In addition, China's reopening from COVID lockdowns represents potential upside risk to our forecast for external trade and tourist arrivals. Meanwhile, growing foreign direct investment disbursements and new restrictions running above disbursements are encouraging, and we believe FDI will remain a key catalyst for further industrialization and premium GDP growth over the next 5 to 10 years. We forecast GDP growth of 6.5% in 2023, in line with the government's targets, and 7% in 2024. Figure 19. Credit to general government percent GDP. Figure 20. International arrivals. Market outlook. EPS forecast still breaks but cheap enough to buy. We lower our year-end 2023 targets for the VN index from 1,400 to 1,300 to set a provisional end 2024 targets of 1,500. Based on our index, EPS growth forecast of 11%, 10%, and 14% for 2022, 2023, and 2024 forwards. The VN Index 2022 closing level of 1,007 represents 2022, 2023, and 2024 forwards PEs of 10.5 times, 9.5 times, 8.4 times compared to 8-year average trailing 12 months forwards PEs of 15.5 times, 13.8 times respectively. Figure 23, EPS growth forecast via index targets and implied PEs at targets. The key downsides to our positive outlook are as follows. Firstly, a deeper than expected global recession that results in greater disruption to production, trade, and FDI. Secondly, higher than expected inflation causing interest rates to be higher for longer. Thirdly, problems of specific property developers spreading to the banking system and the broader economy. Fourth, tighter than expected fiscal policy. Fifthly, tail risks such as an escalation of the Russia-Ukraine conflict for further anti-corruption developments that disrupt economic activity. Banks remain a key swing factor in overall market earnings. While we are already increased 2023, 2024 forwards, NPLs and credit costs follow the 200 basis point increase in interest rates in September to October 2022. Significant deterioration in the economy and our forecast could result in further downside risks to earnings forecasts for the sector and the markets. Figure 28, VCI coverage earnings by sector 2023 forwards. Figure 29, coverage NPAT-MI, net profit after tax MI by sector 2021 to 2024 forwards. Our VN Index EPS growth forecast of 11%, 10%, and 14% for 2022, 2023, and 2024 respectively are broadly in line with Bloomberg's consensus forecast as of end December 2022 of 10%, 13%, 14%. Our EPS growth forecast for our total coverage, which concludes several stocks that are traded on Hanoi Stock Exchange and Upcom, are 17%, 7%, 14% for 2022, 2023, and 2024 forwards respectively. Sectors and stocks for 2023. We recommend overweighting consumer and financials in 2023. These sectors show the second and third highest projected TSR, total shareholders returns, respectively, based on market cap weighted averages of stocks under our coverage. While the real estate sector shows a higher projected TSR based on our target prices, we recommend a market weighting as we expect the operating environment for this sector will remain challenging in H1 2023. However, we believe valuations of the developers with stronger financial positions are attractive on a longer-term horizon, and that share prices could move higher quite quickly. When the market starts to anticipate earlier financing uh, con conditions and uh, improving confidence among home buyers, we would further look to increase exposure to real estate as these issues became clear. Figure 32, BCSC coverage by market cap. Figure 33, BCSC coverage projected 12 months TSRs. After outperformance relative to the VN index in H1 2022, our bull baskets of stocks from our catalyst topics underperformed the VN index by 1 ppt in H2 2022 while our bear basket outperformed by 5 ppts on an equal weighted basis in H2 2022. To recap, all the stocks featured in this package are drawn from our catalyst top picks based on their overall adjustment supported by a better model that we use to examine differences between stocks and several criteria. Exposure to domestic compares to external demand, commodity prices and interest rates, and financial metrics such as leverage and free cash flow generation. The distinction between the baskets is that our bull basket contains stocks that we believe are more leveraged to growth and would therefore be expected to outperform in rising markets, while our bear basket contains stock with relatively defensive characteristics. Net cash or lowly geared uh, balance sheets, relatively high dividend yields, or demand for their products or services that is relatively inelastic. That should support relative outperformance if the market declines. We introduced this approach in our January 2020 Vietnam strategy report with the 3 stock baskets, 2 bull baskets, and 1 bear basket, and simplify our picks into 2 baskets in our January 2021 Vietnam strategy reports. Since then, we have published revised stock baskets every 6 months in our annual strategy reports and mid-year strategy updates. Our basket are not meant to represent model portfolios, as we do not attempt to take account of differences in market caps, trading liquidity, or sector weightings relative to benchmarks indices. The simple average performance of the component stocks in each basket are shown in figure 34, and the performance of stock in each basket in H2 2021 can be seen in figures 36 and figure 37. Our selections are very much bottom-up, driven by and are intended to be more strategic than tactical. However, we also take current share prices and our catalyst projected TSRs into account. Figure 14, stock basket. baskets. Symbol average price changes. Figure 35. Symbol average price change H2 2022. Figure 36. VCI symbol basket H2 2022. Figure 37. VCI bear baskets H2 2022. Figure 38. Guide to VCI fire model. Factor, domestic and external demand. Explanation, what drives revenues? Pure domestic demand scores high, primarily global external demand scores low. Price taker and pricing power. Companies with pricing power score high. Price takers in competitive markets score low. Premium growth opportunity. Products or services in or expected to hit the stiff section of growth S curves score high. Cash generation. Companies generating strong free cash flow. Operating cash flow less CapEx score high. Operating leverage. High fixed costs compares to variable costs such that small increases in mm, revenues drive large increases in profits score high. Financial leverage. High net debt equity or assets equity for banks scores high. A small increase in the value of assets thus drives a large increase in equity value. Commodity consumer compares to producer. Commodity consumers score high. Margins and profits decrease if commodity prices fall, rise. Interest rates. Beneficiaries of low interest rates score high. Highly indebted companies benefit. This part falls disproportionately from lower rates. Our capitalist stock picks or our bull and bear basket for 2023 are summarized below. More detailed discussion of individual stocks can be found in the industry sections of this report. Figure 39 thematic stock basket for 2023. Figure 40 bull basket for 2023. MBB, the most diversified ecosystem among banks under our coverage. Strong growth profile combined with strong provisioning buffer. Success demonstrated in innovating banking apps and attracting new customers. Relatively high CASA ratio. We expect MBB will receive preferential credit quotas due to supporting a distressed credit institution. STB. We expect STB to complete its restructuring plan by end 2023, as we expect sales of one, debts related to Fangfu Industrial Parks, and two, a 32.5% stake in STB pledged as collateral in favor of VAMC in 2023. We believe STB's earnings will soar after its restructuring period and currently forecasts its NPAT to grow at a CAGR of 41.1% from 2022 to 2025. TCBs. TCB's share price plummeted in 2022, which we believe was due to the highest exposure to real estate and corporate bonds among banks under our coverage. However, we believe the bank's high CAR ratio, affluent customer base, and partnerships with top industry players should help TCB to overcome current headwinds in these markets. TCB is currently the cheapest bank in our coverage universe based on 2023 forwards forecast PB. VPB, one of the best capitalized banks, is the most active and in rising offshore funding. Securing a strategic investor in 2023 forwards should further boost capital and improve funding cost. We expect VPB to receive preferential credit quota due to supporting a distressed credit institution. VPB is diversifying its ecosystem, which should create more cross-selling opportunities. DGW, Vietnam's leading ICT distributor with a strong brand portfolio. Equity, Vietnam's premium IT outsourcing company with sustainable cost uh, advantages and strengthened technological capabilities. MSN, strong consumer ecosystem that focuses on customers' daily uh, essential needs. MWG, preeminent player in modern retail in Vietnam, which is undergoing rapid long-term growth. P&J, leading fashion gold jewelry company riding on fast-growing discretionary spending. KDH, well-known developer in the Ho Chi Minh City land and housing segments, townhouses and villas, with a large undervalued land bank in Ho Chi Minh City that will contribute to attract interest from home buyers. NLG, developer with a proven track record in developing affordable housing that currently has projects in the mid-range condo and landed property segments in Ho Chi Minh City and second-tier provinces, in addition to a strong financial position to develop key projects in its pipeline. VHM, market leader in residential housing with the country's largest land bank, proven brand equity and capability to develop large-scale townships to sustain pre-sales and earnings outlook. HPG, Vietnam's largest private steel producer, with established skill and proven operational efficiency. CapEx for a new capacity expansion and product diversification to commence 2025. DGC accounts for at least 30% of world phosphorus exports and has leading cost advantages. 2023 forwards PE looks attractive at 4.8 times despite a year-on-year correction in price spreads. VHC, cost leader in Vietnam's packaging paper industry, which cushions sales volume in periods of weak demand. We expect the company's price spread to rebound strongly in the short term. IDC, a leading IP developer with large cleared IP area in key industrial provinces. Strong profit growth outlook, supported by sales strategy and a change in IP land sales recognition method. STK to continue to benefit from the global shift toward premium recycled plastic yard and other relocation from China. We expect STK's customer orders to begin recovering in Q1 2023 to support manufacturing for the winter season in Western economies in 2023. GMD port operators set for solid capacity expansion and uh, superior profits grow in the next 3 years, while its competitors do not have major capacity expansion plans. VSR. We expect VSR's net profits after tax to drop 50% year-over-year in 2023 to 7.4 trillion Vietnam dong, but this is close to the previous clean cycle peak in 2007. Valuation is attractive. Other 2023 profits PB of 2023 forwards PB of 0.8 times. GAS gas monopoly gas supplier in Vietnam. Gas will benefit from its first NLG uh, project Thị Vải, beginning in 2023 with a 7% net profit contribution, aiming to triple Thị Vải capacity to 3 to 6 million tons and develop the Sơn Mỹ LNG terminal in 2024. HDG is confident that its giant Anfang wind power project will be added to Power Development Plan 8. We forecast an EPS CAGR of 30% in 2021 to 2026 forward. SDG trades at the cheapest 2023 forward PE of 7.5 times in our energy coverage and a 60% discount compared to real estate peers, while HDG has only nominal loan and bond financing for its real estate segment. PC1, renewable energy investor with a record of backlog of 8 trillion Vietnam dong for its power construction segment that was secured in 2022. We forecast PC1's earnings to double in 2023. Figure 41, their basket for 2023. BMI, top 4 player in the non-life insurance market with a strong foothold in the growing health and personal accident insurance segments. Combined ratio in the low end of the market range, we believe BMI's investment returns will enjoy a favorable tailwind from recent interest rate hikes. BCB defensive bank is that is well positioned to tackle economy uncertainty with a strong provisioning buffer, a healthy balance sheet backed by a high quality customer base and conservative loan disbursement approach. Low exposure to corporate bonds and loans to real estate developers, potential higher than peer credit growth from participating in distressed credit institution STEAM. Fee income growth opportunity from bank insurance. CTR. Capitalizing on global mobile data consumption via telecom infrastructure leasing. SAB. Talk to their company in Vietnam with a strong financial position and cash generation. The beer industry offers resilient growth momentum. VRE, Vietnam's large mall operator, developer with dominant market share coupled with a strong financial position and cash flow generation. BMP, leading domestic public pipe producer with defensive characteristic of stable earnings, a solid dividend yield, and low financial risk. LHG, undervalued IP developer that is showing progress on its key IP project in a prime location in Long An province. PHR, natural rubber planter, an industrial estate developer with potential to convert its huge rubber land bank to industrial real estates in fast-growing Bình Dương province. VEA strong exposure to Vietnam's fast-growing automobile and extensive um, motorbike markets, high dividend yields. SCS cargo terminal operator with dual poly position at Ho Chi Minh City Tân Sơn Nhất International Airport will have a strong market and financial position. DCM, one of two largest area producers in Vietnam, benefiting from strong euro prices with a high projected dividend yield 6% to 10%. PPC, expecting a 50% recovery in 2023 forwards net profits after tax and increasing DPS yields. Potential electricity shortage in northern Vietnam benefits PPC and its associates, Hải Phòng and Quảng Ninh coal-fired power plants. TDM, a private water supply company benefiting from growing water demand and water tariff increases in Bình Dương province, owns 37% of BWE, projected 50% and net profits after tax growth in 2023. Of the 11 non-financial stocks in our bear basket, 10 had net cash balance sheets as of Q3 2022, while the other had modest net leverage of 13%. 8 of the 13 stocks in this basket offer 2022 forward dividend yields of over 4% based on our forecast. Share price changes in 2022. Changes in share price in 2022 for all the stocks under our coverage are illustrated in figures 44 to 51. Below are our route according to our industry classification, which differ from GICS standard classification. These charts include stocks for which we terminated or suspended coverage during the year. CII, DHE, GEX, IMP, and NVL. Yeah, and that brings me to the end of my presentation about the challenging H1, H2 to anticipate global recovery. And if you want to open a legal trading account, feel free to contact us with the information on the screen so that we can assist you. Like, subscribe, and share this video to everyone to know more our channel. So thank you for listening and see you next time.